Good afternoon, Debecon class. I am Nikolas Banzuela, and today we'll be discussing about national debt. What is national debt? Well, national debt is the total outstanding borrowing of a central government. It comprises of two things. One is internal debt, which focuses on owing to national creditors. Second is external debt, which focuses on owing to foreign creditors incurred in financing its expenditures. National debt plays a crucial role in a country's financial system, as government securities form an important part of the country's reserves of its financial institutions.
For international trade, it is the exchange of capital, goods, and services across international borders or territories, which could involve the activities of the government and individual. Trades also represents a significant share in the GDP. Trading globally gives consumers and countries the opportunity to be exposed to new markets and products. Almost every kind of product can be found in the international market, such as food, clothes, oil, jewelry, wine stocks, currencies, and water. Services are also traded from tourism, banking, consulting, and transportation. A product that is sold to the global market is called an export, while a product that is brought from the global market is called an import. Imports and exports are accounted for a country's current account in the balance of payments. Some keywords for this are trade deficits. Trade deficits are an economic measure of a negative balance of trade in which a country's imports exceeds its exports. A trade deficit represents an outflow of domestic currency to foreign markets.
How was the problem identified? Looking at the history of Japan over the past 2 decades, its graph on GDP increases from 1990 to 2015. Its debt to GDP ratio is at 240%, which is a huge amount. It started in 1986 to 1991 when it was experiencing the bubble economy, in which real estate and stock market prices were greatly inflated. The bubble was characterized by rapid acceleration of asset prices and overheated economic activity, as well as an uncontrolled money supply and credit expansion. But in August 1990, the Nikkei stock index had plummeted to half its peak by the time of the fifth monetary tightening by the Bank of Japan, or BOJ. By late 1991, asset prices began to fall. But even though asset prices had visibly collapsed by early 1992, the economy's decline continued for more than a decade. This decline resulted in a huge accumulation of non-performing asset loans, causing difficulties for many financial institutions. The bursting of the Japanese asset price bubble contributed to what many called the lost decade. So as the Japanese economy stagnated, weak tax revenue and higher government spending to resuscitate growth created substantial budget deficits. Today, Japan ranks one to have the highest amount of debt next to Greece. Japan's debt exceeded 1 quadrillion yen, or $10.46 trillion dollars, more than twice the annual GDP of Japan. So, what caused the huge debt of Japan? The reason behind the huge debt was first during the mid 1990s. Deflation occurred and has affected the Japanese economy. With deflation, GDP that has not been adjusted for inflation stagnates or even shrinks. The tax or other government revenues depended on the size of the GDP. The stagnation reduces the corporate tax and the government revenues. Other issues that contributed to the debt was the policy mistakes. Because of the deflation, the government tries to implement new policy to jumpstart its economy. In 1997, the government raised its consumption tax to 5% from 3%, believing that recovery was around the corner. However, the move proved premature and backfired. The second reason was Japanese famously aging population. Because of this, it translates into increasing pension, medical, and elder care expenditures. Since these benefits are paid using the tax that the government collected, would result to the long-term problem. But relating it to the economy, when people retire or are unemployed, many households stop making contributions to the pension system while the government has to pay the benefits. The widening gap has been compensated for by government borrowing. The third reason was during 2011 when they experienced a 9.0 magnitude earthquake, and tsunami. It hit Japan northeast section, which was responsible for 6 to 8% of the country's total production. Because of the disaster, many automakers like Toyota, Nissan, Honda, and Mitsubishi temporarily suspended production. Japan is also known for manufacturing 20% of the world's semiconductor products, including NAND flash, electronic parts for Apple. The aftermath of the disaster affected Japan's nuclear industry. 11 power plants was immediately shut down because of the leak and radiation spread, and soon all 50 plants were temporarily shut down for testing. As a result, Japan had to import oil and liquid natural gas to replace generation capacity, causing trade deficits. How does Japan borrow money? Japan borrows money through government bonds. These bonds are issued by the government, and investors buy these bonds in order to receive interest, which the Japanese government should pay. Today, Japan can borrow money easily at a low cost because foreign ownership of these Japanese government bonds was at 8.9%, while 46% are owned by three public institutions. First was the Central Bank, or the Bank of Japan. It started buying bonds since 2001 because it attempts to stimulate the economy and beat deflation. Second was Japan's Post Holdings. It held 167 trillion yen, or the government's debt of 16% total. Third was the pension system, or the public pension funds. It held 62 trillion yen, or more than 6% of the total debt of Japan. Why the problem is important? The problem is important because Japan is now facing an aging population, wherein there are more old people than younger ones. Today, the current population size is at 127.3 million, and its life expectancy is at 83, while its fertility rate is at 1.4 births per woman. Because of this, there will be fewer working age people or less people in the labor force. With less people in the labor force, it will be difficult to increase GDP. There will also be less people to finance Japan's massive debt within the country, because the people are the ones who finance the debt through their savings, which are channeled through pension funds and life insurances. And because of the slow population growth, tight immigration policy does not allow the influx of foreign labor, which could add to its workforce and contribute to growth. Collapse of the Japanese asset price bubble in early 1990s and the following lost decade helped to open inbound trade. Discount markets opened the distribution chains, and several companies turned to foreign trade and investment to avoid losses and even bankruptcy. Products of Japanese companies that were manufactured in South Asian countries were imported at lower price. The Japanese consumer also changed. Economic problems forced many Japanese to look to cheap prices first and care about national pride or superiority quality later. Today, to address the problem, Japan is currently embarking on a monetary program to try and jumpstart its economy and combat its debt problem through growth. The Japanese central bank is essentially printing massive quantities of money and purchasing Japanese government bonds in a bid to increase inflation and spur growth. The Japanese government, together with the Bank of Japan, came up with a plan to increase the money supply since BOJ have the capacity to print more money. If the amount of money circulating in an economy increases, but the supply of goods and services remain constant, then the prices should go up, resulting to inflation. Another was after Shinzo Abe was elected as Japanese Prime Minister in December 2012, Abe introduced a reform program known as Abenomics, which addresses many of the issues raised by the Japan's lost decade. His three arrows were fiscal, monetary, and structural reform intend to address Japan's chronically low inflation, decrease worker productivity relative to the other developed nations, and demographic issues raised by an aging population. Result: Mr. Abe's archery has moved the economy in the right direction. Nominal GDP, which measures growth without adjusting for inflation, is up by about 6% since the end of 2012. Higher prices account for the half of the increase. The unemployment rate has also fallen from 4.3% to 3.4%. Little improvements are seen from 2 decades of economic stagnation. However, it still faces the problem like promoting higher inflation to suppress or reduce government debt.
So now let's talk about national debt in America. One of the biggest issues of global politics is government debt and deficits, which is a particular big deal in the United States because of looming fiscal cliffs. We first need to separate the ideas of debt and deficit. Debt is the total amount of liabilities. Deficit is the difference between what the government spends and what it takes in. In essence, national debt is the net summation of the budget deficits, a debt that the government owes as an indirect debt to the taxpayers. As of February 29, 2016, from usdebtclock.org, the official debt of the United States government is $19.1 trillion. This amounts to $59,196 for every person living in the US, $153,511 for every household in the US, 105% of the US gross domestic product. It sounds like a big number, and it really is. Okay. How did US debt become so big? As indicated in the last slide, debt is the net accumulation of budget deficits. It is important to look at the top expenses, as they constitute the major factors of national debt. The top expenses that increase the national debt in the US are identified as follows. The overburdened Social Security system. The major chunks of expenses go towards Social Security and defense. Some argue that while defense can still be considered a necessary evil, the mechanism to fund a Social Security system has led to increased expenditures without obvious payoff. Payments are collected from present-day workers and used for immediate benefits payments for existing beneficiaries. Due to the increasing number of retirees and longer lifespans leading to more benefits payments, the cost has skyrocketed. Tax cuts from the Bush administration. Bush policies and tax cuts are holding up the government's income, thereby forcing large debts. Medicare. The costs and expenditures toward the Medicare and Medicaid programs have exceeded the projected figures. The general price rise in the medical costs has been the middle culprit, surpassing inflation by a wide margin. The Iraq, Libya, and Afghan wars. Primarily within the defense budget, the continued involvement in these engagements has cost the US dearly in the last decade, adding a huge debt. The public outrage also stems from the belief that situations in these countries were not having any direct serious impact for the US security, as they are geographically far off. As per the reports, around 1.3 trillion were spent on these engagements, which is a huge burden on the national debt. Lastly, we cannot also ignore on what is happening beyond the perimeters of the US soil. Notice how it sharply ramps up starting in 2001. The recessions of 2001 to 2002 and 2008 to 2009 obviously played a significant factor in the increase in the national debt from $5.8 trillion dollars in 2001 to its present level. Because during recessions, there is a decrease in tax revenues and an increase in spending for unemployment benefits, food stamps, and other assistance, as well as spending on programs to attempt to stimulate the economy. According to Alan Yuke's book, Buying Back America, the United States now has a trade deficit with 88 countries. According to the Census Bureau, America's top 7 trading partners are Canada, China, Mexico, Japan, Germany, South Korea, and the United Kingdom. These 7 countries represent 50.9% of America's total trade deficit, which is $461.3 billion for January to November 2014, at an average deficit of $40 billion per month. The 2014 trade deficit with China alone has $314.3 billion for January to November, representing 68% of the total. Some may claim that US is still the leader in advanced technology products, but this is no longer true. The US has been running a trade deficit in these products since 2002, which has grown in an astonishing average of nearly $90 billion per year since 2010. Okay, God. Notice that there is a similar upward slope on the graph to the upward slope of the US's national debt chart. Anyone can see that the US's trade deficit have a significant impact on its national debt. The only thing that kept American trade deficits from being higher than they have been is the fact that they have increased the exports of services to balance their imports of goods as shown by the following charts. As you can see, their trade deficit in goods more than doubled in 1999 to 2004 and reached astronomical heights just before the worldwide recession. Is this a major threat? Well, the answer is no. Businesses spend more than they bring in all the time, as they should, and almost all economists agree that governments are similar. There are times when they need to run deficits. For instance, during a recession, government revenue goes down because wages stagnate and unemployment goes up, but government expenditures have to go up, like on unemployment benefits, for instance. So to be clear, deficits are not inherently bad. And America's current debt, while very large, does not pose a major threat to the American economy because Americans can pay it off through the increase of individual income, SSS, and corporate taxes to pay off its debt. However, there are always repercussions. National debt will affect its citizens. Higher debt levels will mean limited jobs and lower salaries. Increases in interest rates will cause borrowing to becoming difficult at all levels, including for those for individuals, corporations, and mortgages. Organizations operating in the US will be viewed as riskier in the eyes of the world, making it difficult for continued foreign investor confidence and investments in the US. Lastly, and most importantly, the risk of country defaulting on its own debt obligation may lead to further downgrades.